Welcome to the Full Tracy Money Audio Commentary. This is Owen Tracy recording. It's 2:20 p.m. that is Central Time. Today is December 13th. Today being Friday. Also, it's the big picture, long-term audio and video for the various different asset classes. I thought we'd kick off with the Fangman relative to the total market cap of the US market. And it's really an incredible trend where we had a sharp dip in 2022 and then a very significant recovery. And it's still holding the region of the 200-day moving average. So that's certainly supporting the outlook that big tech is still the main driver of stock market returns, where you have 8 companies that continue to outperform. And that is despite the repeated expectation that small caps would begin to take over the mantle of growth and performance, or that the wider market or that the equal weighted version would certainly be a contender for taking over the mantle of performance. That might yet be the case, but when we look at the performance of just those 8 companies, they're still powering ahead relative to the total market cap. And let's think about, well, what's in that small number of companies. So we can just look at those, and it's an equal weighted index. So you have Apple, you've got Amazon, you've got Meta, you've still got Netflix in there. I was very reluctant to remove Netflix because I just thought that it was part of the original number, so I didn't subscribe to the whole Magnificent Seven. Then you've got Alphabet, Microsoft, Nvidia, and Tesla. So let's think about, well, what's driving each of those? Apple has got a FIST product in the iPhone, and there's a repeatable customer base because people are encouraged to upgrade about every 3 years, whether that is because something new comes out or because the current phone they have is no longer good for service. I'm certainly getting towards that level now because the maximum potential charge on my phone's battery is 80%. I'm using myself as a bit of a litmus test. When is it going to get annoying enough for me to actually go ahead and buy? Because that will probably be a signal that lots of other people are doing the same thing. Then we can think about Meta. Well, Meta, and I guess let's look at some of those charts. Because when we think about Apple, the share price remains very firm, and it's pushing on to new recovery highs. Now let's answer a very simple question. Is there any evidence of type 1, type 2, or type 3 trend-ending characteristics? And I think the answer has to be no. We've got a good example of a relatively orderly consolidation for the second half of this year, and now the price is breaking higher and pushing on towards the $250 area, but there's nothing on the chart to say that there's an ending anytime soon. Then let's think about Meta. And Meta has a couple of important characteristics. One is that it owns a large number of the most popular social media properties, but it did miss out on acquiring Musical.ly, and it missed out on the massive growth that TikTok has been able to achieve. So that's certainly a factor. But it has also been the company that has supplied the vast majority of data for training artificial intelligence on. And that was a very, I think, astute move by Mark Zuckerberg in order to blunt the accusation that they were going to become the dominant force in artificial intelligence. They made the data available to everyone while continuing to conduct their own operations. And that has been successful. They've been able to continue to grow out that part of their business, and they haven't faced any kind of opprobrium as a result of it. Then, of course, you have NVIDIA, which has benefited perhaps more than any other company from supplying the infrastructure for artificial intelligence. Now, the share is now pausing, and it dropped today, and it's now below the peak put in the middle of this year. If we think about the difference between NVIDIA and Meta, or at least let's just think about Apple. What will a trend ending look like? Well, it would first need to post a failed upside break. Then it would have to drop down through the bottom of the range underlying, and then sustain a move below the 200-day moving average. If it started to do that, it would look really like a different chart. And then it would have to come back down into the underlying ranges. So that would then be a very significant trend deterioration, and there's no sign of that just yet. Now, if we do the same questioning for Meta and ask ourselves any evidence of type 1, type 2, or type 3 trend endings, well, I think we could certainly have said that it accelerated at the beginning of this year, but then that acceleration gave way to a lengthier pause and an unwinding of the overbought condition relative to the 200-day moving average. And then subsequently it has continued higher with a range above the last one, and then a breakout. So then it's very simple. There's no evidence of trend ending just yet, but if it were to fail at 600 and come back into the underlying range, that would certainly be a warning. If it drops down through the bottom of that range and into the underlying range, well, we could then still continue to talk about perhaps it's a reversion towards the mean. If it fails again there and takes out a midpoint danger line stop, well, then we would be looking at really significant evidence of top formation evolution. So that's, but at the moment at least, we just don't have that. Now, when we then contrast that with the performance of NVIDIA, the share did accelerate to the peak in the middle of this year, also pulled back, and then rebounded, and then pushed on to a new high. So that was all quite consistent and very similar to the performance we had with both Apple and Meta. But now it's failing. So it's looking increasingly likely that the break above 140 has failed, and now it's coming back down to the lower side of its range. Now this might yet look like a reversion towards the mean, which could take the price down towards the 120 level. And then the next question will be, will it find support there? Because there have been occasions when NVIDIA has come back into the region of the 1,000-day moving average, but the last of those was in 2022. And let's now also look at this on a log scale chart. And when we think about it in a log scale fashion, well, then I think we get a bit of a better perspective, because the price at the peak in 2021 was about $35, and of course it's we've had several stock splits since then, and then it got down to 10, which is a very material decline. So the price can fall 60% and still be in the region of the 1,000-day moving average. We're at 133 now. It could come down to 45, and it would still be above the last major peak and finding support in the region of the 1,000-day moving average. And considering that NVIDIA is or has at least over the last week been the most valuable company in the world with a market cap of 3.28 trillion, then the underperformance we're seeing here is, I think, quite profound. Now let's think about Microsoft. They have made several important bets over the last several decades. They first had the dominant position in software for business. Then in the last decade, they adopted the software as a service model, and that gave way to a very impressive uptrend. Then they have gone all in on betting on artificial intelligence and what that might mean for the kinds of services and products that they can create. And the share rallied very impressively from the lows in 2022 and has found support in the region of the 200-day moving average, and then it popped on the upside last week. So now the question will be, will it hold this move? Will it still continue higher from here, break out, and then consolidate somewhere around 500? That would be what we should anticipate from a consistent trend. But it first has to hold the breakout from this little range. We don't have evidence of type 1, type 2, or type 3 here either, although certainly this was a failed upside break in here, and it came down to test the lower side of the range, which has given way to just a longer range. If it starts to drop down through the 200-day moving average and then the $400 area, well, then we have to be prepared for the possibility that it will come back towards the 1,000-day moving average. And prior to the retest of that level in 2022, the last time it did that was in 2015. And I very much think of the 1,000-day moving average as being the touch point for the longer term investor. It generally provides attractive entry opportunities during secular bull markets, and when it fails, then that is usually pretty good evidence that the secular trend has changed. Now, when we look at Netflix, well then, let's think about what the three primary trend endings are. The first is acceleration, the second is a loss of momentum and a massive reaction against the prevailing trend, and then the third one is this long, volatile, ranging time and size type, just massive, big range. Well, NVIDIA is certainly accelerating. The pace of the advances picked up. Since the last time it touched the region of the 200-day moving average, it has risen 50%. So that is a big move in anyone's book, and particularly for a company with a market cap in the billions, up to 392 billion now. Now that sounds like a small company when you look at the performance of some of the mega caps. But certainly the pace of the advance is picking up as it picks up customers. And I would hesitate to say that Netflix is using artificial intelligence, but they've certainly been using an algorithm, and they rely heavily on that algorithm to produce new shows and to manage the kind of content that pops up in front of viewers. And that's certainly been part of the kind of business model that they've been propagating for the last several years. Now let's think about Amazon. It's very well placed in the cloud infrastructure and the provision of compute and data processing. It of course also has its own advertising business, which has become a significant money spinner off of the online marketplace, and that has really solved the big question for the online marketplace was always how they were going to make money out of it, that it was very low margin, and their answer has been to charge sellers for advertising, and they're making really quite a significant amount of money out of that. Then the price is a little overbought in the short term. I wouldn't say that we have the technical consideration that it's accelerating in a big way, but the jump from 150 to 225, that is a 50% advance. So that's also a very significant move we've had over the last several months. So there's not a great deal to suggest just yet that these big moves are over, but there's certainly plenty of evidence that we have increasing short-term overbought conditions. Now, when we think about short-term overbought conditions, Tesla certainly fits into that basket. And this is another example of a share that has gone up a lot since the middle of this year. When it was testing the 1,000-day moving average in August, it was at about 190. Now it's at 431. So we've got a more than 100% advance in a relatively short period of time. And it broke out to new all-time highs in here this week. And this, I think, is more political than any other factor. Tesla is a company that produces that I think mostly produces sedan vehicles, and it has really dominated that sector. They're trying to get into the truck sector. They're having problems with the manufacturing process, and nobody cares about that. They've been promising autonomous vehicles for a long time, and they haven't been able to deliver them. Well, now with Elon Musk's big bet on supporting Donald Trump in the presidential election and his rather privileged position as uh, a very close advisor uh, to the president, there is a clear possibility that he's going to have a heavy influence on the trajectory of regulation. And if you can't build an autonomous vehicle, well, then there's the possibility that they might just change the definition to meet what you've already got, and it would be advanced driver assist would now be considered to be autonomous. And that is being priced into the share right now. Of course, there's the additional point that China is now the dominant force in the demand for passenger vehicles, and what they decide as the most attractive models and business will be the ones that eventually do get built, and that is a lot of electric vehicles, and most particularly hybrid vehicles. What we've certainly seen over the last couple of weeks is that Xiaomi has been jumping on the upside. That was in mildly negative territory today, but broke up and out of the most recent range in just the last week and testing the peak from back in 2021 right now. This has also been a material advance since about August of this year and up over 100%. So when we think about the outlook for the mega cap sector, they continue to be in a very strong position because they have large cash piles. So they can throw money around at any new sector, and they don't have to go to the market in order to justify that. And certainly the way that the US regulatory environment is structured, they really don't favor regulation until there's been an observed problem. Whereas the way of thinking in Europe is that they need to regulate before there's a problem. And then the way that they regulate in China is they will regulate if it poses a threat to the interests of the central government. So the US way of regulation is certainly much more market friendly. Now, when we think about Broadcom today, they announced their earnings last night. They were well ahead of expectations. There's still a lot of money going into artificial intelligence, and the share rocketed higher in here today. Not only did it gap higher, but then it continued to improve upon that performance all the way through the trading session. So we do not have evidence of trend ending here. Now, if we were to see evidence, then it would be a very clear downward dynamic. And this, I think, is important to emphasize. Are we getting to be a little mature in the broader artificial intelligence sector? Well, maybe. And certainly there's been a huge amount of money devoted to the build out of infrastructure. So that is as true of the chip sector as it is of the requirement for electricity. But Vistra, for example, has been among the best performers over the last year and a half. And now it is pulling back down towards the upper side of the underlying range. And if this trend is going to remain consistent, it's going to have to find support exactly here. And this, I think, will also be an important consideration because utilities can't just easily increase the amount of electricity that they provide, but they can certainly charge more for it. That, I think, is going to be part of the business model for some of these companies, where you have the ESG priorities of the large companies, where they really don't want to increase their carbon footprint. Now, I think it's important to emphasize all of this because when we look at the yield curve spread, the 10-year minus 3-month has popped up through zero for the first time since late 2022 in here this week. So an increasingly large number of points upon the curve are de-inverting. And the more back history we can look at, the clearer the emphasis is that you will often see the yield curve de-inverting well ahead of when there's an actual big problem. But it's not so much the point of the inversion. It's when we start to see the spread jumping up through 50 basis points. That's usually when you start to, I think, notice the impact of a de-inverted yield curve. One of the characteristics of the market in between the point when it becomes inverted and when it stops being inverted is that markets go up a lot. And markets did go up a lot between November of 2022 and December of 2024. And they might continue to go up. But if the yield curve spread starts to trend in a dynamic manner up through 50 basis points, then that's a time to be particularly vigilant about the consistency of trends. And then when we think about the 10-year minus the 2-year, which is one of the more reliable lead indicators of future problems, then it's been hovering here around the 15 basis point level for the last 3 months. So it's not surging higher, but it is advancing. Now, it's also important to emphasize that when we think about, well, what exactly is happening in order for that yield curve to de-invert, well, if we look at the 3-month yield, it's not like the 3-month yield is suddenly marching higher. Rather, instead, it's falling. So we have the 3-month falling down towards the 4 1/3% level and pricing in further interest rate cuts. And of course, the Federal Reserve is expected to cut next week. But then we have the 10-year yield, which is going up. So it's really the 10-year yield is now crossing up through the 3-month yield and the 2-year yield. And what that is, of course, implying is that interest rates will be lower in future and that there will be greater demand for protection in the future, but perhaps not quite yet. So the 10-year yield continues to push onwards. And this is, of course, also a version of the bond market rebelling at the thought of interest rates being cut even further, because inflation has not quite been vanquished just yet. And by cutting interest rates, there's the possibility that it's going to stoke inflationary pressures. And one of the reasons why the stock market has been firm is because of the possibility that there will be greater demand because of the speculative interest out there. And then, of course, there's the fiscal side. The US government is running massive deficits. We have the hype around the Department of Governmental Efficiency, which I think is very unlikely to have any kind of substantive action. But that doesn't stop them from talking about it a lot. And of course, if they don't have anything to report, well, I think what they'll just simply do is saying, well, we tried our best. And then the next question will be, what about all the other spending? Because the Trump tax cuts are expected to be renewed. And there is even talk that in order to get them renewed, there'll have to be a significant concession made, because the Republicans' majority in the House of Representatives is not large enough to push through just about anything. So they might have to make a concession on the state and local taxes write-off, because lots of people that might normally vote in favor of tax cuts, they are going to have a responsibility to their voters in places like California and in New York. And if you're a Republican in either of those states, you really have to show that you're doing a good job for your constituents, because otherwise they'll just turn around and vote in a Democrat. So that's obviously a significant factor, that there's going to have to be a lot of horse trading around whether we're going to get an extension of those tax cuts, and then on top of that, additional tax cuts. And the bond market is certainly voting against that as a viable possibility. So it does suggest that if the Federal Reserve cuts rates as expected next week, that it'll probably be the last time. And we have this very strong move in the larger cap companies. And that's obviously also an important consideration. Now, it's important to think too about the march of technological innovation, because artificial intelligence has really captured the imagination of investors, and there is pressure on CEOs at just about every earnings call to talk about how they're using artificial intelligence, how they plan to use it, and what kind of wonders it will provide in terms of their worker productivity. And then there's the whole evolution around quantum computing. And I think it's rather interesting that Google is very well positioned in terms of its cloud offering. And now it has rebounded very emphatically over the last several days in response to the big innovation that it announced from its quantum computer. There's talk about the possibility that we are living in a metaverse, that Google has tapped into additional possible worlds. And I think that's one of the most important considerations, that when we think about what alternative worlds are, it isn't that they exist, it's that they're proto. And the reason that this world exists is because it is that which is most perfect, and that it is the most likely to occur. And the defining characteristic of reality is that it does exist, whereas there are myriad, infinite numbers of additional possibilities. And that is in fact how a quantum computer works. They look at what is the most likely possible scenario out of an infinity of possible outcomes, and then they give the greatest weighting to that which is likely to in fact exist. And the pace of innovation that is occurring in the development of these kinds of computer is truly mind-boggling. When we think about the innovation that delivered the artificial intelligence chips, well, it was subject to Moore's law, and even Moore's law has been slowing down over the last decade as the physical limits of silicon are approached. Then on top of that, you have the evolution of quantum computing, and they say that it is exponential, which means that it is improving in powers rather than multiples. And when that happens, then you can get the kind of innovation in 10 cycles that you would in 1,000 years of an exponential cycle. And those kinds of numbers are exceptionally difficult to get one's head around, but that is what's evolving. And when those types of computer are eventually made commercial, then the possibilities are that everything else will be obsolete. But we're talking about, I think this is something that is on a similar magnitude. Let's say, for example, if a battery technology was developed where the energy density was greater than that of gasoline, so that you could charge it with a relatively easy access to either nuclear technology or solar or wind. And then it would have the same specific gravity and the energy intensity, or better than energy intensity of gasoline. Well, if a battery like that existed, and it doesn't, but if it did, well, then the entire logic for sustaining the fossil fuel industry would be in ruins. And then you would have an enormous amount of stranded infrastructure. And we'd be looking for ways to try and come up with some use for it. Now, that's not readily apparent yet, but innovation in batteries is improving. And we continue to see lots of companies talking about the potential that they're going to sorry, it's QuantumScape is what I was thinking about. QuantumScape is talking about building out its manufacturing capacity for solid state batteries. Now, their biggest problem is that they're late to the party. And you have companies like Contemporary Amperex in China. They're building out their manufacturing capacity. And the share is consolidating following a break of its downtrend. So this continues to look like a recovery. Now, when we think about bull markets and what drives them, well, one thing that drives a bull market is technological innovation. And that really is beneficial all around, because technological innovation tends to be inherently deflationary, because it's about doing more with less. And when we think about the inflationary trend that's been evolving over the last several years, well, technological innovation is certainly a potential solution to that. But then you also have to think about credit. And we're in a rather interesting environment right now, because the Chinese government is talking about introducing additional new stimulus, but they're not doing it. And the volume of stimulus that they're willing to provide is painfully inadequate. So when we think about the performance of the H-share index in Hong Kong, it dropped down again today. So we had a pop on the upside earlier this week on the promise of additional new liquidity, and when it has not been delivered, then the price starts to come back down. That's a very clear signal to the Communist administration that talking about it isn't going to get the job done. They're going to have to put their money where their mouth is if they want to try and support the economy. And while the 10-year yield in the USA is rallying, the 10-year yield in China is accelerating lower, and it dropped down through the 1.8% level today. So there's an acute risk of deflation, potentially even recession in China. And that, I think, is not really being priced in. And when we think about the outlook for copper, well, there's a lot of talk about the evolution of the battery sector, but you can't have a big bull market in copper without China participating. They hold almost all of the refining capacity for copper, and then they account for over half of all demand. The big pop on the upside for copper was as a result of China entering the World Trade Organization. the sustained price around the 400 level is intimately connected with Chinese demand. And the whole outlook for a big new bull market in copper, and at the expense, I guess, of oil, is 100% dependent on China's demand. And on a day when copper was down, oil prices were up. Inventories at the Cushing facility in Oklahoma are at their lowest point for this time of year in 16 years. So Brent crude is steadying from the lower side of its range, and it's been up for 2 or 3 consecutive days now, and approaching the region of the 200-day moving average. I think that when we look at the outlook for credit, well, what the bond market is telling us is that there's a risk of inflation, but central banks are cutting interest rates because they are absolutely focused on trying to achieve the soft landing. Then when we think about the access to credit, well, this is, I think, rather important. I was thinking about the TED spread when I was looking at this the last couple of days. And then, of course, I remembered that LIBOR isn't actually being updated any longer. I was very curious how Bloomberg was actually drawing a chart that was coming all the way up to today. When one of the data points, they stopped updating it a couple of months ago. So I've redrawn the chart, and then this time I'm taking SOFR. So taking 3 months SOFR and then plotting it relative to the 3-month yield. And what this tells us is that it's at an elevated level, but it hasn't broken out yet. Now, the problem with looking at this sort of data is we don't have the back history. So the TED spread isn't going to be as reliable in an historic fashion as it has been in the past. But access to credit, therefore, is not as problematic as it has been, or it could have been if reflected by the original TED spread. Then when we think about the banking sector, banks are doing great. And the S&P 500 Banks Index has done spectacularly well over the balance of the last 12 months. Now we're getting some pause and consolidation right now, and at least some unwinding of the short-term overbought condition is to be expected following that acceleration. But I don't think there's anybody especially worried about it just yet, even though there's certainly the potential that we can have some consolidation, and particularly for regional banks as they come back into the region of the 200-day moving average and encounter resistance in the region of the peak from back in 2022. When we think about what the Fed is doing, well, they are continuing to reduce the size of the balance sheet. And when we think about global central banks, well, the ECB is cutting interest rates. China is reducing reserve requirements, moderately cutting interest rates. The Swiss National Bank cut rates yesterday because they're trying to devalue the franc relative to the euro. When we think about the UK, they're cutting interest rates. Australia's cutting rates. Brazil had cut rates. Now they're starting to raise rates. The total assets of central banks has been contracting. It's currently at 25.8 trillion. And I'm going to try and draw the chart again. But what we have here is evidence of central banks cutting interest rates, and they're not giving up on reducing the size of their balance sheets. Massively inflating balance sheets was an emergency measure in response to a global financial crisis. And then those central banks, they let their balance sheets continue to expand for the next decade. And now we're in this lengthy period of unwinding the size of the balance sheet. In order to sanitize the impact of this, the standing repo facility was created by the Federal Reserve, which basically puts the full printing press ability of the federal government or the Treasury, I should say. No, the Federal Reserve's unlimited ability to print money is at the disposal of the financial markets with a standing repo facility. So even though we're in a period of quantitative tightening where the total assets of central banks have come down from about 33.5 to 28.8 trillion, it has not had a material impact on the performance of the stock market. And then let's think about the size of the Fed's balance sheet. It has broken the correlation between the performance of the stock market and that of the shape of the size of the balance sheet. When we think about the S&P 500, it is still pushing on to new highs and modestly negative this week overall, but still holding the sequence of higher reaction lows and the small ranges one above the last, modestly overbought relative to the 200-day moving average. It could pull back by less than 10% and still be in the region of the 200-day moving average. Now, when we think about the Russell 2000, there was a lot of hope that this would become the big performer, and it has done quite well since the beginning of since the bounce from the region of the 200-day moving average, but now pausing in the region of the previous peak. And then the equal weighted index has been doing better, but not to the extent of the performance that we've seen on the wider market. But with the equal weighted index breaking on the upside, it suggests that at least the benefits are broadening out, even if the strongest performance is still from among the biggest companies. Then what we've also started to see is a greater focus on other parts of the financial sector. So Block, for example, popped to the upside 2 weeks ago and was a bit softer in here this week. And we might get some consolidation following such a strong move on the upside. But the buy now, pay later sector, that was heavily impacted by the jump in interest rates. And with interest rates coming down, it's starting to benefit once more. So that's a significant potential beneficiary of lower interest rates if that's the way that the economy evolves. The benefit for the USA has been in the regulation of high technology, where there's a real willingness to allow it to evolve without getting without government becoming too involved. And that really is one of the strengths of the US market. Europe's markets have suffered from the nanny state, and the Europe Stock 600 is still pausing in the region of the peaks put in towards the beginning of this year. Then the weakness of the euro, I think, is also something that is a very significant factor in the underperformance of the market. It's not going to be as attractive from the perspective of foreign investors if Europe doesn't do something to support the currency. One of the biggest challenges is not just about markets, it's also about the politics, because there's just a vacuum of leadership. There's just doesn't seem to be a clear vision for what can be done to try and reignite growth and risk-taking behavior and, I suppose, confidence in the European project. Instead, what we have is this really almost existential discussion going on around how to pay for defense in the face of aggression from Russia, how to meet the obligations that that means, or the fresh obligation that I guess, that has been foisted back upon Europe, while simultaneously sustaining the benefit regime that lots of these countries have signed up to as part of their own internal social contract. Now, there's a strong likelihood that the Ukrainian war will end with a negotiated settlement, and that Russia will hold on to a land bridge to Crimea, and will hold on to Crimea and a good portion of the eastern part of Ukraine, which includes its gas fields and a lot of its industrial base. So that is what Russia will settle for, I suspect. And Europe is probably not all that enthusiastic about supporting Ukraine's defense indefinitely. But at least there will be a rebuilding effort, and that would certainly be beneficial for the construction sector. And then with the end of the regime in Syria, there are certainly some of the Turkish construction companies and Israeli construction companies are looking like they're going to benefit from reconstruction as well. Reconstruction will certainly create demand for steel and cement, and that's potentially important for a country like China, where they have a large amount of spare capacity. And then the build out of really historically large infrastructure projects in Saudi Arabia. That's also a key source of demand for steel. But the big challenge is that China is totally dominant within the steel sector. And Europe's steel market has been just going sideways for 20 years. This was a brief period of time between 2004 and 2008 when it did particularly well, and then in between it's really just hasn't been going anywhere. The price today is pretty much exactly where it was back in 1999. So for ArcelorMittal, which is among the largest steel companies in the world. What it really helps to emphasize is that we've had a massive commodity bull market, and particularly for industrial resources, there's plenty of them around. So the outlook for steel is certainly something that has at least got a potential for bullish action. But the price is still ranging and still holding right in the region of the upper side of the longer term base formation. When we think about the performance of some of the mining companies, well, they might yet do better, but they're not firing on the upside. And BHP Billiton is trading below its 1,000-day moving average for the first time since 2020. So when we think about where the bigger trends are likely to be, high technology remains a significant candidate. And then the potential is that there'll be a lot more building work going on. But then the question will be, where will that building take place? And do we already have the resources for it? I think that China is very keen on its automotive sector leading the way for a manufacturing revolution to absorb a lot of the pressure from the downtrend in the domestic economy. And that pretty much means that they're going to be very keen on batteries, and lithium is still at a very cheap level. And a lot of the expansion of mines has been curtailed, but Albemarle pulled back in a rather sharp manner in here today. So we're in a rather interesting environment where there's certainly a lot of enthusiasm around artificial intelligence still, and particularly the build out of infrastructure. Quantum computing is exceptionally exciting. Innovations in batteries are still very exciting. And those are helping to drive interest in some of the larger technology companies. But then we can think about the range that we're getting in gold right now. The price was down another $30 in here today. Now, I was saying earlier this week that it was probably presumptuous to think that the consolidation is over, and that has been borne out. It does look like we're in for a lengthier process of ranging. And what that suggests to me is that China might yet still be buying, and they started buying this week, and that was part of the reason why the price popped on the upside. But the 10-year yield is rising, and that is a headwind for gold. Now, when we think about or at least how can we look at the real yield? One way is to simply look at the TIPS yield, and that TIPS yield bounced in here this week. So that is beginning to put downward pressure on gold, because gold benefits when the trend of real yields is rolling over. So it started to really perform when it looked like the TIPS yield was trending downwards. And this move we've had this week is suggesting that maybe there's a possibility that the 10-year yield will take another leg higher, because investors are worried that the drive towards additional spending and stimulus from the Trump administration will reignite the inflationary pressure, and the Federal Reserve will be reluctant to hike rates aggressively. And that's the other way of thinking about it, that gold does best when you have real yields that are contracting, and gold does best when you have an inflation problem where the government is not willing to, the central bank is not willing to raise rates aggressively enough to kill it off. And what it suggests then is that gold will be in a volatile fashion. When inflation does start to pick back up again and the Federal Reserve is reluctant to cut interest rates or to raise rates aggressively, then gold will pick up again. So we're in a range for the moment. Then let's think about Bitcoin, because Bitcoin does particularly well when there's a lot of new liquidity being created. So we're certainly seeing the central banks of the world cutting interest rates, and China promising additional new stimulus. And the Federal Reserve is due to cut interest rates next week. But if we get an accident happening somewhere, then that is going to be fuel for a significant pop on the upside for Bitcoin. It does best when the volume of cash being created by central banks is surging higher. And Ethereum is back in the 4,000 region and testing the upper side of a 9-month range. And several others of the altcoins are also starting to do better. So with Bitcoin above the 1,000 level, we're approaching the point where we'll start to see some greater interest coming through into the mining sector. But we're not quite there yet for the crypto miners. There's obviously a lot to think about from the longer term perspective. The pace of technological innovation is still very exciting, and that's a big, I think, bullish characteristic overall. Then we can think about the outlook for interest rates, and I think that's going to be very clearly tied to the outlook for fiscal spending. And with the volume of fiscal spending that's being proposed, we have to think that inflation is going to be an issue. And we're in an inflationary boom right now, because people have come out of the pandemic with the perspective that you only live once. So they want to buy, they want to go out and enjoy themselves, they want to have experiences. That's certainly helping to fuel interest in enjoying oneself. So lots of interest in the the hotel sector and in travel and cruises. And some companies like Royal Caribbean, they have been very firm, and that's leading a significant recovery. And Royal Caribbean is very overextended, I should say, right now, and certainly due some consolidation. Carnival Cruises has really only just begun to break out of its base formation, but it's a little overbought in the short term as well. So that way of thinking is also rather inflationary. People only thinking about you only live once. That if you don't do it now, you might not be able to afford to do it later because prices are going up. That kind of inflationary mindset, where you get precautionary spending, that's that also is one of the things that focuses the mind on inflation. And then, of course, property prices remain really quite strong. Now, there's, I think, an evolution within the perception of housing. The housing market has, the number of transactions has started to improve again after a very quiet period in 2024. The number of houses being built is certainly starting to increase. But I think the big change that has happened in the USA over the last few months has been the prevalence of no money down options. That these are being sold now, and new first-time buyers are being educated about how they can get into mortgages with no money down. Then, when you think about the UK, the Labour government is talking about building a lot of new social housing and giving councils specific mandatory targets that they have to achieve. So we are entering a period now where there will be a lot of building, and there's a lot of state-directed spending that's going on. Now, you might have that state directed spending priority change from one government to the other, but it's not stopping that volume of cash. And that is very reminiscent of what happened in the 1970s. We had an initial pop on the upside from inflation, and then there was an effort to try and introduce price controls. And when those had to be abandoned, then inflation really took off. Well, this time around, we don't have the price controls, but we might just have inflation continuing on the upside. And that, I think, is something that's going to be problematic for the bond market. And having unwound most of the overbought condition for the yield, or the overextension relative to the trend mean for the yield, now we're starting to see that yield push higher. Now, higher interest rate costs are obviously going to hit a wall at some stage. That the ability of companies to continue to fund themselves, and will they then have to raise rates and raise their prices? And of course, that will contribute to inflation even more. One thing that has been very clear is that insurance costs are still very firm, and insurance companies are only just starting to moderate. And I think that decline in the S&P 500 insurance index is down to United Health. There's some moves towards breaking up some of these big health insurance companies, or getting them to sell their pharmacy wings. But the insurance sector has pushed the pressure from higher yields onto premiums, and they're sustaining their margins by simply charging more. And I find it interesting that there is a lot of speculation about whether the large technology companies should be accused of antitrust, and we don't seem to have the same conversation about insurance companies at all. That they're all raising premiums. And they're also all refusing different kinds of business because they think they can't make money from it. But of course, that does beg the question, not so much whether they can make money, but whether they can make the margin that they desire from it. And that is, I think, if they're all pursuing the same margin, that is an antitrust accusation, and probably something that will be out there in the future. So we're still in an overall bull market despite a large number of short-term overbought conditions. There's large unanswered questions about the impact on the fiscal of the massive fiscal stimulus, but one clear conclusion is that any kind of stimulus inflates asset prices, and that's exactly what's going on. When we start to see a loss of uptrend momentum, that would certainly be something to pay attention to, but it's not readily apparent. And when the advanced decline line rolls over, and most particularly when it starts to pull down through the most recent lows, or pulls down through the 200-day moving average, well, then that would also be a lead indicator for future problems, or at least a coincident indicator. So I think we're still in a bullish environment overall. There's obviously a market that climbs a wall of worry. We also know what to be worried about, and those factors are not firing right now. Oil prices are not surging. The yield curve spread is disinverting, but not surging higher. And the banking sector is more like overbought everywhere, not just in the USA, but in the UK. The banks have been doing exceptionally well. In Europe, banks have been doing well. Japan's banks have been doing well. So if I think about where is the potential biggest problem out there, well, it's one way to think about it is that it might be the fiscal problem that is looming for the USA. But the potential is that China might have a recession, and that could have a knock-on effect for lots of other countries, and most particularly those that are exporting commodities or the other emerging markets that rely on China to buy their exports. And the Australian dollar is on the cusp of breaking on the downside. The New Zealand dollar is under pressure. Then Brazil, where the outlook for inflation hasn't been as benign as everyone had hoped, the real looks like it is going to break additionally on the downside. If I had to think about where is the epicenter of risk right now, it's in China. And they really need to pull the trigger on stimulus, or they're going to have a really significant threat from deflationary forces. And I think with that, I'll leave you for the weekend, and I'll wish all the best to all of you.